Well, you're watching Strictly Money. Now let's move on to our advice session. Not surprisingly, more hotel rooms are vacant across the UK as cash-strapped customers decide to stay at home. In January, revenue in the sector declined by more than 12%. That's according to Vision, a company which advises investors in the hospitality sector. Joining us for more is Clive Hillier, the CEO at Vision. Clive, thanks very much indeed for joining us. The hotel sector, of course, has changed, as we were just talking about, in the last decade or so. Many investors buy the property and then get a management company to come in and run that for them. Yeah. How is that model faring in this downturn? What's happening?
The intrinsic elements of that model mean that the risk has been transferred to the property investor. The hotel brand company is taking a fee for managing the hotel, which is based upon the actual revenue of the hotel and also the profit of the hotel. But the lion's share of that fee is driven by revenue, not profit. And therefore, in the current climate, where revenues fall but profits fall more significantly, then the risk is shifted to the investor. And the investor therefore needs to have every tool available to them to drive the best performance of that hotel at the bottom line, because in the current climate the brand operator is not as focused on their...
I was going to say, how can they do that when the management of the hotel is with someone else who isn't quite as focused on the profit? They're just interested in actually getting revenue through.
Yeah, well, in two ways. Firstly, hopefully, if they were properly advised in doing the deal in the first place, there will be structures within the management agreement that help them protect their cash flow in a downside scenario. If that's not the case, then it would be possible for the operator and the brand to simply sit there and say, well, I'm sorry, that's the deal you signed. But you have to remember that these brands are now very driven by their pipeline of new hotels, and it therefore does not sit well for them to sit back and do nothing and see their investors struggle, because down the pipeline there are fewer hotels coming on stream.
So you can go back and say, look, we need to renegotiate.
Absolutely, and one of the interesting factors of this particular recession is because it hits the States earlier than the UK and Europe, we are finding that the hotel brands that are American-based are more sensitized to the problems than they would have been in a normal circumstance.
And how has, like, the falling property prices, I suppose, helped you and in terms of sort of buying up properties for you guys to work on? Is that been something that's worked in your favour? Well,
it's something that theoretically works in your favour, but as you know, in the current climate, liquidity is the problem. So just as the argument of reducing interest rates is interesting, but what does it actually do for the mortgage market? The same applies in commercial property and in hotels. Firstly, no investor and lender wants to actually realise their assets at the moment unless they absolutely have to, because the market is in a downturn. And secondly, even if they were to attempt to realise their assets, there's a great deal of problem in any investor finding the liquidity to actually do deals in the market. So at the moment, we are finding that investors and lenders are much more interested in working through downturn problems than they are in actually trying to crystallise assets.
Yeah, there was a lot of hedge funds, private equity groups sort of got into the hotel business in the last 5 years. How are they faring right now?
Well, I think one of the challenges for them is that they're now realising that they've actually bought a hotel business, not just a piece of property, and therefore actually the interaction with the brands and the operators is paramount, and therefore using experienced asset managers to drive that relationship is important to them now.
Do you think that there's quite a lot of scope, I suppose, for insolvencies in the hotel industry, the hospitality industry? Is this something that is sort of threatening the industry?
We have had already with Folio Hotels and Real Hotel Company, we have had some failures, and there will undoubtedly be some failures. But one of the inherently encouraging aspects of the hotel industry is that people still stay in hotels. There may be less people, but people are still staying in them, and therefore cash does come out of the bottom line of the hotel. Obviously, in the retail market, in the office market, when your tenant fails, the lights go out and the property is vacant. Little of that happens in the hotel industry. They just tend to change hands.
You look at numbers from Whitbread yesterday, who own obviously the Premier Inn chain. I mean, and Premier Inn seems to have done incredibly well in this downturn. Is that? I mean, is there any other model besides that that's working, or is that where the money's going? No,
there are other models, but certainly Premier Inn and Travelodge at the lower end of the market will be more resistant to the current climate. We're also seeing mid-market offerings like De Vere's Village offering, which has a sustainable offering that people are very happy to stay at, but doesn't embarrass you when you put your expenses claim in at the end of the month. So we are seeing that there are some products in that area that are being particularly successful.
Clive, good to see you. Thanks for joining us. Clive Hillier, CEO at Vision.
Thank you.
Now here's a reminder that you can ask questions to any of our experts on any topic that we have covered today. Do get your questions into us. So the address is strictlymoney@cnbc.com. But let's move on.